All right, let's get started, everybody. Good morning, and welcome to the Gulf Intelligence Daily Energy Markets live video podcast. Today is Monday, March 6th, 2023, and we've got three experts here with us today from different parts of the world. I'm happy to welcome Omar Nahia, Global Head of Derivatives at BB Energy, Peter McGuire, Chief Executive Officer of XM Australia, and Victor Yang, Senior Analyst at JLC Network Technology. Thank you all for joining us today.
Thank you.
So today, the talk of the town is China. China brought down its growth forecast for the year to a level not seen for decades, probably at least over the past 30 years. Meanwhile, Europe is insisting that it's no longer dependent on Russian energy, and there's a lot of speculation coming out of the US over mixed signals with the Federal Reserve. We want to know what this means for the direction of markets, and we seek to gain insights into these topics in today's session. What does sometimes feel like the rest of the world is stuck between this tug of war mentality between China and the US. And Peter, I wanted to ask you, on the one hand, we have, this optimism, let's call it, over Chinese reopening the past 2 months maybe at this point. But on the other hand, we have this nervousness developing over what's interpreted as a hawkish Fed policy coming out of the US. It might hurt the US market. And I'm curious your stance on the balance between these two poles right now they're developing.
Yes, and good afternoon. Greetings from Sydney. If we're going to look at the Fed first, you're seeing so many different opinions from different members of the Fed. Some are saying as high as 6%. I saw last week it was going to be, we're pretty much focused in on, laser zone at around about 5.35 by July. Now some are saying 6, some are saying more than 6. So I think it's very much a work in progress. The animal that we're trying to tame is certainly inflation. And with energy prices ticking up, food prices the way they are, and that's globally, then the impact to the consumer is felt pretty much across all of Main Street. And it doesn't help from an inflation standpoint that record low unemployment rate, which in turn everyone's got a job that wants a job and probably needs a job to feed themselves. And that in turn forces the inflation spike to even, trend even higher. So there's the first part, where are rates going to be? The second part, as far as China, yes, we understand from, the GDP number and, forecast moving forward, and a little bit like what Omar said, 5 to 5.5. I'll listen to Victor, and he's got legs on the ground there. It's all interesting, the rhetoric. We understand where the COVID policy's been. We understand moving forward. We understand certainly from a property standpoint to try and re-stimulate a component of their market or their GDP that's worth about 30%. And it's a fractured investment landscape in a lot of ways across residential property, and how that's going to, move forward, because it's just such a large contributor to overall Chinese internal demand. So and naturally sentiment. So as I sit here, Thomas, we've got through the first 2 months. China didn't really come out of the blocks that convincingly in my eyes. I mean, I look at across Asia today, everyone's got a green light except, China, but only down a fraction. CSI 300 down 5.52, and you got the Shanghai Composite down 0.19. So I'm not too worried about, Asia today. Let's keep our focus on where energy moves, and naturally the US dollar in the short run lead up to Easter. It could be interesting times, Thomas.
Well, you mentioned how inflation is top of mind, not only in the US, but markets all over the world. And market reactions specifically throughout Asia were mixed, it seems, in response to China's expected growth rate of 5%. Australia's bourse, for example, rose 0.6% ahead of the Australian Reserve's decision on Tuesday on whether to raise hikes. And many economists are expecting there to be a 25 bips hike in an announcement coming out this week. And I'm curious your thoughts on what you think an announcement might look like.
Well, we're around about, let me look at it, around about 20 hours away. I think I was talking to some people today. I won't be, some are saying 15 basis points, by the way. Some are saying 25, and you've got even the outliers at 50. So it's throw the coin in the air and let's see where it lands. But 25, I think, is pretty much baked in. That's where the Aussie's playing at that point. And I sit here, hand on heart, 25 basis points, but I won't be surprised if you saw a 50. quite simply because they're going to play catch up compared to other economies that have moved far more aggressively and quicker, like New Zealand, over the ditch, and naturally the Fed. So yeah, we're going to play catch up with an inflation rate running at 7.4%. They've got to manage that and manage those expectations.
Well, it's interesting what you bring up about Europe, because probably ideally for the US, Europe would act in lockstep when it comes to policy towards Ukraine and policy in general. And Peter, to Omar's point, the EU Commission President Ursula von der Leyen said over the weekend that the EU is no longer dependent on Russian oil and gas. She called it a thing of the past, considering, like Omar said, that Russia cut 80% of its gas exports to Europe over 8 months, and that US and Norway have stepped in to fill that void. And I'm curious your thoughts on whether you think that statement is a fair representation of Europe's situation, or if those statements might be true right now, but could be outdated in a week or a month from now.
Well, if I can refer to yesterday's edition of the Financial Times, page 2, that we probably all may have read, let me just read one small paragraph, and it regards UAE and Russia. And people put the UAE officials clamped down on suspected sanctions busting. Washington is worried that the UAE is becoming a hub for shipping electronics and other items that can be repurposed to help Russia's war effort. So people familiar with the discussion said one worry was re-exporting where goods were routed through the UAE to sidestep restrictions. Now, there's an example of Russian goods or rerouting them, and a similar mindset as far as energy. So while we sit here, we understand the position where Russia is, and it wants hard currency, and it's got some very strong allies, both in the oil market and naturally geopolitically with the likes of China and other nations with their BRIC. So it's going to be this protracted war I don't think is anywhere near finishing just yet. And it could be quite tumultuous over the next matter of months when hardball becomes nearly impossible on every side of the equation. And remember that they've got oil that can, and if they spike it, with a geopolitical situation, that can really create much angst to the consumers all across Europe and naturally the rest of the world.
Yeah. And as we run up on time, we just have a few minutes left. Peter, one more question I wanted to ask you regarding the energy transition front. We had BP's US business saying that it's going to stick to its promised transition away from fossil fuels, even while it's also planning an aggressive oil output increase. It had planned to slash oil output by 40% by 2030, and now it's been revised downwards to 25% by 2030. And at the same time, it recorded record profits in 2022 after Russia's invasion of Ukraine, when oil surged. And I'm curious your final thoughts on this. And are these energy transition targets, are they posturing? Are they meaningful at all? Your take.
Wow, there's so much to answer in around about 90 seconds. I sit here in Australia and I have a different footprint as far as electric vehicles because of the sheer geographic size of Australia. We aren't Europe. We're a country that is 4,000 kilometres from east to west, Perth to Sydney, and people driving the sort of how far we can actually drive an electric vehicle. If you're driving into the country, then you have to spend so much time getting it recharged. So we've got to go through and try and minimize not the transaction, well, it is a transaction cost or a transaction time frame, the actual charging of these vehicles. And all of those factors need to be really reduced to make them far more attractive, I think, to the consumer. And whether we're going to hit those numbers or not hit those numbers, BP forecasting and then revising it down from 40% to 25% is a massive haircut. So I sit here and shake my head in some ways and just let's see how it all plays out. But I will say this, if you're looking at what BP are saying, we're certainly going to be looking at $100 crude in the next matter of months, according to the big boys out in the market. the second half of the year, and I think that will underpin the real energy situation where we are globally.
Thank you. Well, definitely a lot of revisions, a lot of projections that have been revised recently, and probably a few other announcements coming out this week on further revisions to projections to look out for. But that's all we have time for today. I'd like to thank our three guests for joining us today. Omar Nahia, Peter McGuire, and Victor Yang. Thank you for taking the time to speak with us today, and have a great rest of the day.